We are truly fortunate today to welcome Matt Burton as a guest on the Squashing the Market podcast. A graduate of Sewanee College in 2007, Matt is now a grizzled and successful veteran of the startup, FinTech, AdTech, and venture capital universe. He held a range of roles at AdTech pioneer AdMeld until it was acquired by Google in 2012. And then after a stint at Google, Matt joined LiveRail, which was subsequently acquired and very quickly and sold to Facebook. Matt and a group of colleagues then founded Orchard Platform in 2014, which was acquired by online lending platform Kabbage. Matt recently joined FinTech VC leader QED Investments, and he's done all of that by age 35. Incredible. Welcome, Matt.
Thanks for having me, Bill.
So, Matt, let's get started. The resume is super impressive. You've done so many things, but tell us about the journey and some of the key moments from college to QED. What were some of the pivot points and what made you start companies, join companies, and become a venture capitalist?
Yeah, I mean, I think if I look back, at really kind of graduating from college, I didn't know what I wanted to do, to be completely honest. I had interviewed at quite a few companies in New York, some big, some small, kind of all over the place. I kind of fell into my first job at Operative because really they just needed warm bodies at that point in seats. They were growing super, super fast. They were hiring probably 15 people a week at that point.
What kind of business was Operative?
So Operative was an ad tech business. And so really focused on this massive change from kind of traditional media to online media. And so the clients were, the big ones were Fox Interactive, which owned Fox News and owned MySpace later on, et cetera. And it was really these companies trying to figure out digital. How can I not only create the content, put the content up, but how can I monetize it? How can I sell ads against it? How can I make sure those ads were served? And then how, most importantly, can I collect the money? And so Operative was a great experience, both because, it grew very, very rapidly, and then it ended up not scaling well. And so it ended up, laying off most of the staff and kind of downsizing. And so I got to kind of early in my career see both the positives of startups and also, the negatives if they're not built in the right way. And then that kind of really opened the door to looking for a company that was going to be, have all the right ingredients to be successful. And that's when I found AdMeld. And at the time, it was just the two founders and a handful of engineers, and really allowed me to kind of get in at the ground floor.
So you weren't put off by the fact that a startup, kind of your first startup, blew up in essence, and you sort of jumped right back in the pool.
Yeah, I mean, I think that I was so impressed with the amount of knowledge that you can really come away with in these companies, because when they're growing quickly, there's no time to hire people. And so new problems are coming up all the time. And so you just kind of, even if you're 21, 22, right out of college, you'll find yourself, with way more responsibility than you ever thought at these early stage companies. And that's what kind of attracted me.
And so AdMeld then gets sold to Google. You're at Google, but if I remember correctly, you were kind of on the beach at Google.
So what ends up happening, at some of these bigger tech companies is really they buy their competitors, really to put them out of business. A big part of them buying us was so that we would just no longer compete with them. And so when we got integrated in, there was, small portions of our features and stuff that kind of got added to Google AdX, which was their competing product. But for the most part, they shifted the team onto other projects because they were just looking for, one less competitor in the space. And, it's hard to fault them. They've had this strategy for a while, and now they, pretty much have a monopoly on many parts of the ad tech ecosystem, which was really, video was one of the areas that they were struggling. And I could see it because there was a big fight going on between the group I was in, which was the Google Ads group, and YouTube over who was going to own video. And so I could see that this fight was causing them to really fall behind in this important category at the time. And that's really why, many of myself and many of my colleagues ended up going to LiveRail, was because it was like, oh, who's going to benefit? Well, clearly this company is going to benefit. And most of us thought it would just sell back to Google within a year. Right. So when it ended up selling to Facebook, it was a little bit of a surprise. And it was kind of at that moment that I stepped back and said, do I really want to keep going in ad tech? Like, what does the future look for it?
So this would have been around 2012, 13, and you have companies like On Deck and Lending Club and Prosper growing rapidly, FinTech starting to take a lot of momentum on. But you've been an ad tech person the whole time. How did you make that pivot into financial technology?
So I think one of the interesting notes that people don't talk about very often is the fact that it wasn't a smooth journey. I actually ended up pitching VCs, I don't know, the Orchard idea 9 to 12 months before we actually ended up getting funded. And there was no interest whatsoever. Why is this ad tech guy, trying to move into peer-to-peer lending, et cetera? And I just kind of stuck with it. The initial idea was going to be a much more of a retail product to help them manage their peer-to-peer lending assets, because myself and my co-founders of Orchard, we were all investing our own assets on the personal side. And so it was really the feedback I got from VCs, and kind of went back and thought about it more. And then when we started to watch the institutional investors move into the space was really when it said, oh, okay, I think that now my pitch to the venture capital community is going to be right. And sure enough, when we did it the second time around, we had a lot of interest.
So you shifted the business model from retail to institutional capital
Exactly.
flows. So you've had experiences as a founder, as a worker at startup companies, and now you're at a venture capital firm, QED Investors. Talk about the transition to QED. How did that come about?
Yeah, so I think the funny line about VCs is no one ever dreamed of being a VC when they were going to grow up. Everyone kind of accidentally ended up in this industry, and I think my story is the same. Kind of post selling Orchard to Cabbage, the shifting of some of the remaining assets. So now Velocity / Short Hop, is still the piece that's run by Jonathan Kelfer, who was my co-founder as well. Once that was all kind of settled, kind of looking out, I really needed a break. I'd been kind of 5 years of grinding. And so, ended up saying, okay, I'm going to take, some time this summer, and kind of relax. And then I got a call from Nigel and Frank, initially saying, hey, come help some of our portfolio companies. And, kind of they had been an investor in Orchard, so I had gotten to know them super well. I knew QED was known for really leaning in with the companies, and a lot of VCs say value add, but what it doesn't really actually come to be. And so they were really trying to kind of, live through that and add value. And so that's kind of how I kind of stepped into it, was initially just working with them kind of part-time.
So you've been in the VC world a little bit now, but do you think there are commonalities between a successful venture capitalist and a successful entrepreneur, or are those two different worlds?
I think they're two different skill sets. One of the biggest kind of surprises for me was just the feedback loop on the VC side is just so different. Every day when I was an operator, I would have, information and data coming back to me saying, am I moving in the right direction? Are we kind of, hitting our numbers, and kind of, you have a constant kind of almost drinking from a fire hose in the startup world. And on the VC side, it's you make a bet and then you might not know for years if it was the right decision. And so that transition, I've realized is requires a very different set of skills and quite a bit of adjusting to get used to it. The thing that I think is similar is the network. As kind of a startup founder, you end up kind of really networking in with the rest of the community, because it's so important for not only getting investors and building relationship with the press, but also really your kind of peers, so that you can lean onto them for support and help with recruiting and all of those pieces. And so the network that you build out kind of in the startup world has obviously a high overlap with the kind of VC world. And so that's where I think that I've had an advantage, where my network sources deals for me. I don't have to spend all day long reaching out to companies. People know what I'm interested in. They know what I'm excited about. And because I've built this network in New York over, this last decade plus, it makes it a lot easier to basically see kind of some of those opportunities early.
And your network today is global.
Yeah, I spend a lot of time on the global side. So FinTech is not a U.S. trend.
Right. We're going to talk about that in a bit. Frame for us where the VC world is today. the WeWork debacle seemed to have soured a lot of let's call it the common person's view of venture capital and crazy valuations and what are these people doing? How did this happen? Talk about the impact of WeWork on the venture capital community. Or is it just business as usual and this is just, these things happen from time to time?
I think that the biggest wake-up call with WeWork was just everyone said, had a reevaluation of what multiples you should be investing on. What you saw with WeWork and what you've seen with some other companies like Peloton and Uber and others is when they were raising money in the VC community, they were getting tech multiples. And then when they went public, they were getting much more traditional multiples. And even some of the, direct-to-consumer brands, I think everybody's starting to realize that you're going to get 1x revenue for these businesses. You're not going to get 8x or 10x, that the private markets were giving some of these businesses. And so I think that's kind of the adjustment is going through. Now it takes time, right? Because startups don't raise, if you're not public, you're not raising money every day or they don't have the ability to. And so, I think over the next kind of year or two, that will slowly kind of diffuse into the rest of the environment. But on the early stage side, it's still very competitive. I look at the world in which, when I moved to New York City, the type of money you could raise as a startup and the valuations you could get versus today. It's still, people are calling it frothy, but it's very high. There's still a lot of capital out there.
Lift the curtain on the venture capital, the mysterious venture capital world. What are some of the common misperceptions out there by LPs, by people who aren't as familiar with the venture capital space as other areas of investment? What are some of the things that people don't understand or don't get about venture capital?
The first kind of misconception that I see quite often is that they think that VCs are all about picking companies. That there's this democratic process where the entrepreneur goes and pitches, 20 VCs, and the smartest VC will be able to identify which is going to be the great company and pick them and back them. In reality, what you find is that picking companies is really, really, really difficult. And so the best VCs tend to have, a brand and a reputation where they get pitched first. An entrepreneur who's coming out with an idea, will typically pick kind of 5 or 6 VCs as their first round, kind of their tier one. And if you're in that tier one, you actually have a huge advantage. Your deal flow is a massive advantage in your ability to actually create outperformance. And so people don't understand that the worst thing about VC is where you're actually, not seeing the best deals, and therefore you're getting adversely selected. And given the failure rates, getting adversely selected in this industry means that it's very easy to have negative returns.
Right, because things can go to zero.
And they often do.
And talk about that portfolio approach. Are venture capital firms reliant on a very small percentage of winners to make their returns to LPs? Is that the basic model? If there's 20 investments in a portfolio, 3 of them work, and that's how LPs get their 15 to 25% return?
Yeah, I think the biggest thing about the VC world is that the returns, on the top quartile of VCs are just very different from kind of, everything else. And so when you're the best, you can, it happens not regularly, but you can have 5x, 10x, 15x funds. And so when you see these outperformance on the fund side, it normally is because 1 or 2 companies were just breakout successes. Now, if you don't have a breakout success company, but you do well, you can still get your fund to being kind of in that 3 to 4x, right? Which is what I think most VCs aim for. Just for everybody's understanding, kind of typically it's, a 3-year investment period. And then kind of, the fund life is anywhere between 7 and 10 years, just so that people have context on that. But the way that I think about it is you're really believing in this business at the earliest stage, and you believe that they're going to grow at, 100, or they're really going to grow at, 2-3x per year for a decade. Right? Like that's what you're really betting on is that there's such strong product market fit that these companies are going to continue to compound. And that's really what drives, most of the return.
Does that mean you avoid businesses that are potentially very good, but just aren't going to grow quite that fast? They may be fast growers, but...
Yeah, I think the most difficult position that I've found myself in as a VC is when I see a business and I'm like, wow, this is a great business, but it's much better as a lifestyle business where it's going to be very profitable, on a small scale, under 20 million in revenue, but very profitable. And this would be awesome if I was a private equity investor because I could just divvy this out and make my returns that way. VC doesn't work like that. The opportunity cost of our time requires us to really aim for companies that at minimum can get to 100 million in revenue.
Let's take a step back and talk about financial technology. That Squashing the Market podcast is all about investing and FinTech. FinTech is many things. It's payments, it's exchanges, it's wealth management, it's Bitcoin, it's a lot of things. What are the areas of FinTech that you and QED are most interested in today? What's going on in the industry?
One is on the international side. So QED is unique, is the fact that the firm just invests in FinTech. And in order to actually make that work, you actually need to invest, more on a global basis, because if you just are a sector-specific fund in one geo, then the trends within that geo, are going to be a huge impact, on you. And so if the U.S. fintech market is having a bad year, well, you're going to have a bad year. And so by investing also in Latin America and also in the UK, and Europe, and even extending on, I just got back from India, and we're looking at some opportunities both in India and Southeast Asia for the first time ever. It allows you to be able to kind of say, okay, well, we've seen these trends play out in Europe, and now we expect them to play out in the US. Or we've seen this breakout company in Brazil with this amazing business model. We think that with a couple tweaks, there's probably opportunity for this business model to work. The other area is really this trend of the first wave of fintechs was really broad. You had Lending Club who were saying, my customer, is every kind of US consumer. And where we're seeing kind of where the puck is headed within fintech is much more focusing on specific user groups that have specific needs. And instead of just having one product to a large population, you have a smaller population, but you have multiple products that you sell them. And so whether this is landlords, which we have one investment in, kind of a vertical landlord bank that wants to do lending, payments, bank accounts, insurance, a full service on this, or doctors and dentists. So we have an investment in Lendeavor, which focuses on products just for this. And it's everything from, loans for, buying out kind of a senior doctor or dentist, so practice finance, all the way through all the other services. We're looking at businesses that are focused on musicians, businesses that are focused on high net worth foreigners who want to buy assets in the U.S. These very specific groups that have needs that where we think that they can build kind of a real moat around their business. Because the issue is the version 1 fintech players, when they went public, and you can see it in the stock, they didn't really build enterprise value. There wasn't really any moats in their businesses, and the banks were able to copy them pretty easily. I think the version 2 that are, have multiple products are going to have, much, much higher enterprise value.
And that's because those entrepreneurs and those businesses have core competencies and expertise in a particular customer base. It sounds like dentists, doctors, musicians.
Yeah, and I think they're just stickier. The idea that down the street from us is Goldman. The idea that Marcus is going to build out a product just for doctors and dentists, I just can't see it happening, right? Because everything in the banking DNA over the last 30 years has all been about, how do we simplify our product set? How do we have one product that reaches as many people as possible? You see, less and less credit cards out there. You see less and less types of mortgages out there. There's really been kind of this Walmart kind of banking services that has gone on. And so the idea to flip it and go to, we're going to personalize everything, I think it would be just very, very difficult for them. And I think that it's also one of those things that it's hard, just doing kind of a, unsecured consumer credit card refinance product is not that hard. Figuring out payments, lending, insurance, bank accounts. I mean, this stuff is hard, to do well.
You've been through the process of raising capital as a entrepreneur for a company. Take us through that process. How does it work? How do people do it? What are the difficulties involved? What are the risks, the rewards?
I think when I, was making the leap from being a startup employee to really being a founder and going out and raising money, the advice that I'd wish I had been given is that, it's really about a narrative. It's really about a story that you're trying to tell, which says, one, what is the gap in the market that you have identified that no one else is seeing? What's the opportunity that no one else is seeing, right? And being able to tell a compelling story on why that opportunity exists. And then the second part is like, why you? Why are your skill sets the perfect person to fix that? It's not enough for there to be a problem in the market. There also has to be, you have to be the perfect one to solve it. And really, working on that narrative is much more important than the deck. I wasted a lot of time working on decks, and it makes you feel like you're making progress, but you're actually not making progress because no one makes a VC decision based on a deck. You're going to sit down, with angel investors or with, venture capitalists, and you're going to get 5 minutes of a coffee meeting. And in those 5 minutes, when you meet them for the first time, you have to tell the most compelling 5-minute story of your life. And that is what you should spend 95% of your time on. And if they're telling you that your story is not good, take that feedback and adjust it to something in which, that they get really excited about, because VCs do have a lot of experience. They hear, 1,000 pitches a year. And so I think that's kind of the advice that I find myself giving to entrepreneurs.
I know you've been traveling a lot, and you mentioned it before, FinTech is truly global. Talk about what's going on out there. What parts of the world, in your view, are leading FinTech? What are some of the trends you think that are happening abroad that may be coming to the U.S. or vice versa, U.S. to other areas of the world? What's going on out there, and who's ahead? What regions?
So I think the big stories right now are obviously the neobanks in Europe, which have grown rapidly there and have all kind of announced that they're coming to the U.S. We're still a little bit skeptical about kind of the unit economics of many of these businesses, but look, the trend is there, and they're spending money and raising money, and so you got to pay attention to that. So I think that's kind of one big global trend that's going on. I think the second one that I've been following very closely is what's going on within kind of the real estate side of FinTech in Brazil is super interesting. I think a lot of that will end up getting exported to the U.S. So making of real estate easier to buy and sell and manage and lease and all of these pieces, I think that the developing world, because it's such a broken problem there, a larger problem, they're solving it first there in ways that I haven't seen quite come to the U.S. yet.
We've seen a lot of real estate platforms here in the U.S., Realty Mogul, Peer Street, et cetera. What's different about the platforms you're talking about?
So the platforms here on the real estate side are really just capital markets kind of plays and investment plays and sort of, some level of arbitrage. They're actually, in many cases, buying the properties themselves, putting up insurancy guarantees. They're active, in the process of transforming real estate in these markets. There isn't kind of the same level of national data sets on what homes are worth, and it's the amount of friction that goes on in any transaction in Latin America is just 10x what it is here in the U.S. So
there's room for fintechs to come in there,
correct, and
streamline processes,
correct. And what's so interesting is that once they get their foot in the door, and a good example of this is like Nubank, right? It's not real estate, but once Nubank got their foot in the door with consumers on credit cards, their ability to cross-sell bank accounts and and they have a bunch of other products kind of in queue, has been amazing to watch. Cross-selling is one of those things that at QED we really didn't believe in. It was one of these rare things. You were either, USAA, who was able to do it, but for a very particular reason around their target kind of population, or you're Wells Fargo and you were lying about your cross-selling. Everyone else has kind of not had success with it. But I think that we are seeing now the beginnings of, especially with financial products that are delivered through apps. If you can make it easy where it's one click to cross-sell and they don't have to fill out a new application, they don't have to talk to anyone, you're really seeing kind of these walls get broken down.
What are the red flags or the alarm bells that go off when things aren't going well at a company? What do you start to see? What's the early warning system at QED or for any VC, frankly?
This is going to vary by stage. So I think my feedback is mainly around the seed stage. And at the seed stage, you're really looking for product market fit. The big hypothesis is, do people want to buy this thing? If product market fit, is found, it typically shows itself up in the sales numbers, right? And so you're seeing that kind of organic demand come in. You're seeing, the CEO is able to close the first 10 deals themselves with no problem, or the partnerships, and everything feels great. Every entrepreneur knows when you have product market fit. It's like the greatest feeling in the world. The problem is it's hard to find, and so most of the time, kind of, and people talk about the kind of trough of sorrow in startup world where you're looking for it. And so I think that typically when it's not going, things aren't going well, is typically when you haven't found product market fit. You're trying to sell something, you're not getting the pull through numbers you thought, or you're not getting the size contracts you wanted. And so really, it's a lot about at QED, okay, well, what do we need to change? Right? If it's not working, we cannot do the same thing tomorrow that we did yesterday, right? We have to figure out some twist. Sometimes it's a business model twist, right? Sometimes the product is amazing, but the way you're charging for it is not, acceptable for that corporate, right? We watch a lot of companies try to sell into banks, and they're very tricky to figure out how to charge banks, and how it's going to be, accounted for on their end, and what's the tax treatment. There's a lot of complexities. And so really it's, if we're seeing the forecasts, come in below, it's really saying, okay, well, how do we lean in and try to help them find product market fit?
So it's that time of year. What would be your 2 or 3 predictions for 2020 in terms of FinTech?
I think it's going to be 2020 a really interesting year. You have a bunch of kind of the high flying FinTech guys who it's really uncertain how they're going to, play out. You have Robinhood, who raised at huge valuations, but now you have the incumbents who have now cut their costs to zero and really changed kind of that landscape radically. You have Chime that just raised a ton of money. So you have all the European guys coming over. So a lot of money is going to be deployed in 2020. I don't think we actually know what that's going to do to customer acquisition costs and what it's going to do to, how many of these business models actually work. And so I'm very interested. I think we haven't had that many IPOs in FinTech, and the ones that have gone out have been a mixed bag at best.
At best. Lending Club, On Deck, Green Sky have all been on the red side of the ledger, if you will.
Yeah, I mean, the real winner has been Square.
Absolutely.
And, in the private markets, Stripe is still, very high. I mean, the trend of kind of payments providers adding lending, has been, a way for them to really be able to become attractive, companies. And so you're kind of watching that playbook play out. But, these investments can only stay illiquid for so long. You really need to start to see some of these other companies go public. I'm very interested to see kind of this dynamic between the public markets and the private markets on the late stage.
One of the things I love to ask all the guests on Squashing the Market is about their own personal investment journey and how they organize their own finances. Talk for a moment, if you will, about your investment process personally, saving for the future. Talk more broadly about your approach to investing personally.
Yeah, my approach is one of diversify. And I kind of take this to an extreme. So if you look at kind of my portfolio, I have kind of the traditional 401k from all the companies that I've worked at.
And in those 401ks is typically stocks, bonds, index funds, would you say?
It's for the most part all kind of, target, what is it like?
Target date funds
and Cheap and Vanguard, and really just trying to not beat the market. I'm just trying to find the cheapest way to access kind of the consistent. Then kind of my next piece was real estate. So I own real estate both in New York and in Texas, for kind of investment properties, and really view that kind of passive income as being a key portion. And then I'm heavy in the alternatives bucket as well. So within alternatives, I have angel investments that I've made. I have advisory shares that I've agreements that I have with some startups of my friends. I obviously through QED have kind of carry and funds that are diversified across kind of a large number of startups there. I own crypto, and I still have kind of small holdings in kind of the peer-to-peer lending space as well, and some of the kind of alternative real estate platforms that you were talking about, really just to try to get into everything that I think has a chance of outperforming over the next 30 years.
But there's a lot of income generative assets in there, the real estate. You're clipping a coupon in a sense.
Exactly. I mean, and my view is that is an important piece, right? It's not just the 401k, the target funds. I do want income generating. And even, I know in a previous episode you had Zach on, even my crypto holdings right now, I have being put to work at BlockFi because I really want to make my assets work for me as a key goal on that. And just, have that level of diversification that the chances of all of them kind of, blowing up at the same time is very low.
So we've reached that point in the podcast where we do what's called the lightning round, where I'm going to give you pairs of words and you're just going to pick one. You don't have to say why, just pick one of the two alternatives. So here we go. IPO or sale of the company?
Sale of the company.
Texas or New York?
New York.
Angel investor or Series B investor?
Angel investor.
Bitcoin or the US dollar?
Bitcoin.
US Open or Wimbledon?
US Open.
Asia or Latin America?
Latin America.
Silicon Valley or Silicon Alley?
Silicon Alley.
Preference rights or board seat?
Board seat.
Management fee or carry?
Carry.
Tennis or squash?
Tennis.
Thank you, Matt Burton. It's been a pleasure having you on Squashing the Market.
Thanks so much, Bill.